Hi everyone, welcome to this Q&A session. I've got some interesting questions to cover, so let's get started. The first one is from a pilot in Hong Kong, and they're saying that they've got 2 paid-off properties in South Africa, and they're basically wondering whether these properties are still worthwhile investments. And I've got some numbers that I'm going to run and show you. But they are saying that, that it's making a profit. It's not making enough of a profit that is actually taxable because it's split between the husband and the wife 50-50. And then also their current cash flows are just sitting in an F&B account, and that they are not, really doing anything with the cash that it generates. They've recently opened a TFSA, but are considering selling the properties so that they can rather put the money into the stock market. So if we look at the numbers that they've shared, Property 1 has a value of 1.1 million. It has an annual income of 132,000, and then they've got rates, taxes, and levies. This is an assumed maintenance, an annual maintenance. And this number is from them, by the way. And that they also don't pay tax on this because they are not taxpayers in South Africa. So this is below the threshold that they get taxed at. And it's split between the husband and the wife, the income. And then, so if I calculate the yield, the yield on this based on these numbers, then that's a 6.7% rental yield. Then let's look at the growth of the property, because of course the property rewards you in 2 ways, as a rental yield and then also as capital growth. Capital growth, they paid 860 for this property, and in 2025 it's valued at almost 1.2 million. And if we calculate the compound annual growth rate on this, it's 2.14. This property is in Johannesburg, so this is definitely on the lower side, but this is also realistic, and this is unfortunately what the growth on Johannesburg properties look like. That would mean the total return, which is basically adding the yield and the capital growth together, would be 8.8%. The second property that they share, here's the data for it. It has a value of 2.2 million. It has an income of 186, and then levies, rates and taxes, and maintenance, which looks a little bit low, the maintenance on this value of property. But anyway, this is then the net income on it, and the yield based on those numbers is 5.4%. I think that if you then consider the capital growth on this, they paid in 2013 1.7 million for it, and in 2025 it's worth 2.2 million. That's a growth of just 2.2, almost 2.5%. And the total yield then would be this 5% plus the 2%, which gives you 7.82%. So their properties are generating a return between 7.8 and 8.8%. And yeah, so in general, this is, I would say, for a low risk investment, this is not a bad return. It's comparable to what you would basically get on a savings account for your money. And of course, if this makes up, I would also want to ask, if this makes up a significant portion of your net worth, then is it really wise to expose a significant portion of your net worth to 2 properties in South Africa, especially considering that you're living offshore and these returns aren't great. It's like under 10%. And you can also compare it to what the global stock market or the MSCI World has returned in rand terms, which, depending on the timeline that you're considering, between 12 and 14%. So, of course, these returns would be subject to tax. The capital growth portion would be subject to tax, and also the But the capital growth portion of these returns would be subject to tax, as is the case of the MSCI returns, for example, that I quoted on the global stock market. Okay, and then something else that I would also consider is it not a nightmare? They told me that they're not using agents to rent this property out. Is it not a nightmare for you to be managing this? These returns aren't great enough that I would say, wow, hold on to this. And of course, now we're using assumptions, like we're not sure if the capital growth would look different in the future. But it is, I know that managing tenants can be such a nightmare. And also, I've heard some horror stories of people saying, new tenants come in, after 2 months they stop paying. It's really hard to get them out. For 6 months, you go without rental income. Then it becomes really you're very exposed to one property and a tenant that doesn't pay. And also, it's a headache. They're reporting things that don't go wrong over the weekend might be bothering you. If you really are keen on real estate investments or getting exposure to property, rather consider a real estate investment trust or a property ETF, for example. Those can also, by the way, give you a good idea of what returns look like in general on property investments. Anyway, so I think that is like my quick input on that. Oh, the other thing, sorry, that I actually also wanted to add is that this calculation does not consider tenant vacancy periods or non-payment from tenants. So this is, like, I would say, quite a good picture when it comes to returns. But it also could, of course, look different if the tenants stop paying or if the property is vacant for a period. So the next question is from a 30-year-old artist. This is an interesting question. She's basically saying is that she can live anywhere in the world, and she's currently a taxpayer in South Africa. And she asks that should she move her tax residency somewhere else because she is not employed. That means she could not apply for the 183-day rule does not apply to her, which is a rule that applies to if you earn foreign income and you're employed abroad. As a South African tax resident, there is an exclusion that you could qualify for. And then she said that the most art that she sells is internationally, but she has some sales in South Africa. She's 30 years old, and her thoughts, she's thinking of moving tax residency. She mentions Madeira and then staying in South Africa for less than 90 days and in Ireland for less than 90 days. Yeah, okay, so she's basically asking what is her best tax saving scenario. So this is an interesting question, and actually also something that digital nomads ask a lot. Is because you are not employed but you're working abroad, then it's hard to qualify. Well, you cannot qualify for that foreign income exemption. And the thing here is that, okay, so first of all, I have to say is that I'm not a tax practitioner. I have a good understanding of tax law and international tax law, but it's always worth your time to consult a tax expert on this if you want to, get your things in order and make sure that you're in the, doing this in a tax optimal way. The thing here to consider is that if you want to change your ordinarily resident, SARS applies a rule first of ordinarily resident. So they're asking, where are you ordinarily resident? Where is your home? Where is your gym contract? Where are your pets? Where do your kids go to school? So they ask these questions to see, it's like home is where the heart is. Where is your heart? Where is your family, etc.? And then only if you fail that, they would apply the physical presence test. So for you in order to prove to SARS that you are now ceasing your tax residency, that you're becoming a tax resident somewhere else, you would have to be able to prove that you are now ordinarily resident somewhere else. So that would mean you pay tax in that country. That means you have a residence permit or a visa for that country, that you have a permanent address there, and that you're basically able to prove that you've moved your residency somewhere else. So to just spend time in different places outside South Africa will not allow you, or that will not enable you to prove that you have actually formally moved your life or your residency somewhere else. If it is worth your while to considering something like this because your income becomes very significant, then it would actually mean that you would physically have to move somewhere that permanent, where you have residency, where you have a permit to live. And I'm assuming in this case, perhaps you just have a South African visa, then you will need to consider which countries would offer you a visa to live there. And then you would become taxable in those countries, right? So it's almost like, okay, but then you're going to become taxable somewhere else. So you're going to pay tax somewhere else anyway. Your living costs are likely going to be higher depending on which country it is. So it's almost weighing these things up against each other. It's not possible for you to completely dodge tax unless you go, for example, and live in Dubai. Then it would mean that you're not taxable. Dubai doesn't apply tax under certain thresholds if you're an individual. So you're not going to pay tax in Dubai. But then your living costs would skyrocket. So saving on the tax, yes, but paying significantly higher living costs because you have to be able to prove that your life has actually been established there. So some thoughts, some things to think about for you. Then the next question is, my mom was a teacher for 30 years. She did not earn a big salary. She earned below the level needed to pay income tax. And during her working years, she contributed to her RA. And it's now paid out because she decided to retire early. And what they're basically saying is she's not needing this money because her father is basically paying for all of the bills. So the money is just lying in an account. And it's in a 30-day notice savings account. And they're asking whether they can consider a TFSA for her. I don't think you're ever too old to consider a TFSA. The thing really here is to think about risk appetite and to think about when you're going to need the money. Because if something worst case happens and your mom actually needs that money to live off, let's say something happens to your father and he's not able to cover the bills, or if your father has a plan in place and he's got assets that your mom will inherit, then potentially, yes, it's an idea for her to invest this money. But of course, stock market investments are volatile. So consider if her timeline really is long and she would definitely not need this money within the next 10 years, then a stock market investment in a TFSA is not a bad idea. But yeah, of course, think of the timeline and think of the risk appetite before you make any decisions there. Okay, and then I think we have time for one more question. I had a question from an engineer in Cape Town. Oh, this is a good one, saying that I've mentioned a few times that if you have extra cash, it's better to invest the money rather than trying to pay off your bond. So I don't want to definitely not give that as a blanket statement there, but I'm going to explain why. Does this mean that I would rather say take on a 30-year bond where you're basically paying your house over a longer timeline rather than a 20-year bond, because that would mean less cash flow towards your bond and more money to invest? I think most important thing here is that you shouldn't overspend on your house. Just because your bank is willing to give you a mortgage for a certain amount doesn't mean you should take that entire mortgage and take on a big mortgage on a house that technically you should be not putting so much money towards. So the rough rule of thumb is a third of your cash flow towards housing, which, I mean, if you can get that down, that would be amazing, because that would actually free up more of your cash to invest as, for long-term goals and for long-term growth. But if you're considering the trade-off between investing and paying off your bond, something that is actually very important to note, and that's something that someone commented on one of my previous videos, is if you're putting money towards your bond, let's say your rate on your bond is 11%, and you've got R1 million, for argument's sake, or 100,000 Rand that you're putting towards your bond, you're saving on 11% of interest, and that's almost a guaranteed return that you're getting. You know that the return that you're getting on this money is you're saving on 11% of interest. On the other side, if you're thinking, okay, should I rather put that into the stock market returns, let's say rough benchmark, MSCI All World Index, depending on the timeline, 12 to 14% in Rand. This is historic data. Of course, we don't know whether it's going to look like in this in future. That return is still taxable. So if we want to consider a return net of tax, a portion of the return would be subject to dividends tax and another portion of it will be subject to capital gains tax. But let's say if we consider a rough 20% tax, because capital gains tax at the highest rate is 18%, but and dividends tax is 20%. Let's assume like a worst case scenario tax of 20% on the gains, then it would be 14%, which is then subject to a 20%. I should be able to do this mental math, but so on that side it would be after tax. On the higher benchmark in my mind of 14%, after tax it would be 11%. So on the one side, potentially saving guaranteed return of 11% on your bond by putting the money there, or potentially getting an 11% return in the stock market, but it's not guaranteed because it is volatile. It could be better, but it also could be worse in a downturn. So I actually would rather want to say in this case, I would go for the guaranteed return on the bond. That does not mean go for a 30-year bond rather than a 20-year bond. I think what's much more important here is not to put too much of your cash flow towards your mortgage. Please let me know your questions. You can submit them via the form in the caption. If you have more questions, I'd love to answer them next week, and I'll see you then. Please let me know if you like the Q&A sessions in the comments so that we can do more of them. Okay, have a great day. Bye.